man, it's time to do another Q&A video.
Hey everyone, Ryan Bolton here, local mortgage expert, ryanbolton.com, answering more questions off the internet that relate to real estate, mortgage financing, all this fun stuff. So let's just dive right in. I like to keep these videos under about 20 minutes. If you have any comments, questions, or concerns, please post them below and we'll get to those in a future video. So let's go ahead and jump into as many as we can today. How long does a pre-approval for a mortgage loan take? So most pre-approvals are very short in the sense of the information that's gathered. But to make sure that the pre-approval is accurate or as solid as possible, you do want to gather up some of the income information and anything else that the loan officer may ask for to make sure your pre-approval stands up. But generally, a pre-approval, we can find out within minutes. It is not something that should take weeks or months or anything crazy like that. Once we have the application, depending on your experience level or the type of products you offer, you should be able to tell a client very quickly if they're approved or why they're not. Maybe it's a credit score issue or a down payment issue or a debt ratio issue. But generally, the application will allow us to get a good idea where the client's at and what they'll be approved for, which loan program they'll be approved for, those types of things. But to get the actual solid pre-approval, they usually want to double check the income that you stated. I mean, on the application, you could say you make 10 grand a month, but doesn't mean you actually make $10,000 a month. So having the pay stub or W-2 or tax returns, however you earn your income, can make sure that pre-approval will actually hold up and stick before you put your offer in. So as an experienced loan officer, I'll get a pretty good idea where my clients are at based on how they answer the questions, how the debt ratio looks, how their credit scores look. There's a really good idea of what we're dealing with if there's any red flags we need to address before we issue a pre-approval letter, or if we can issue it that very same day. So it shouldn't take very long. It really should not take very long to get a pre-approval. I have mine done in minutes at times, as long as there's not some reason they can't be pre-approved. Next question, is it harder to get a mortgage for a condo? Yes. The reason being is that condos don't own the land they're sitting on. So the homeowner doesn't own the land that the property is sitting on. So you could be a 2, 3, 4 level condo. You don't own the land. The HOA owns the land that the building is on. Also, the problem that you have with condominium projects is you will typically have a lot of renters, or you'll have a lot of single owners that is a landlord of a bunch of other units. So if that person ends up running into financial hard times or loses the property, they kind of drag down the entire economy of those units because they're so similar. They're cookie cutter, 2-bedroom, 2-bath, same square footage. They don't really have a lot of separation on what they're worth, which there's some benefits to that as well. But generally speaking, for lenders, they don't want to go into a situation where one owner can affect that much of the marketability of the units, or they have harder times getting them foreclosed. There's certain things that kind of happen within condominium projects. With FHA, you actually had to get the condo project approved before it was started, and many builders didn't go through the hoops of getting that approved because they just didn't want to deal with having to follow the guidelines of an FHA loan. Well, now that these units have gotten more affordable than other homes out there, you're starting to see spot approvals or go back and try to get the approvals to make them condo ready. Warrantability is another word you could research. That is one of the problems with condominium financing. One way that some builders and developers have gotten around this is reclassify the properties as townhomes and actually sell the land with the units. So that's one way that some developers have gotten around this whole thing. But the short answer, is it harder to get a mortgage on a condo? Yes. There is more hoops to jump through, a little bit limited on which lenders will loan to a condominium project, and usually have to have a little bit more money down. All right, let's see what else we got. What are the risks of taking out a mortgage to buy a home? Well, that's really what a mortgage is doing. Is it's buying the home with the mortgage at the same time. So you get approved for that home. The loan gets placed on that home at the time that you settle, and you sign your paperwork at the end of the closing transaction. So what are the risks of taking out a mortgage to buy a home? That's one of the major ways to do it without paying cash. So if there's any loan or lien against the property, it is a mortgage. That's what a mortgage is a loan against that property as collateral that if you don't make your payment, that's what they take away. So some of the benefits of a mortgage is you can spread out the cost of buying it over time. So instead of having to come up with $500,000 today, you can spread that out over 30 years. Of course, there's an interest rate tied to that, but that interest rate is locked in during that entire time. It's more fixed than rent or other types of expenditures when it comes to owning or when it comes to living in a home. So rent is the other option, basically, other than buying it or having a mortgage. So some of the risk of having a mortgage is if you don't make your payment, you'll lose the house. But the mortgage company does not own your house. It's just the collateral you're using. If you don't make the payment, they come and take the home. So that's one of the risks. If you don't make your payment, you'll lose the house. Let's see. What is the current fixed rate interest rate? They fluctuate every single day. It changes on a daily basis. Also, the rate that you're going to get might be different than the next person. There's not just one rate for everybody. The rates differ based on credit scores, debt ratio, type of property, use of the property. So whether it's a primary residence, a second home, or investment property, loan to value is a big factor. So if you have somebody that is putting 5% down versus somebody, say, putting 20% down, the rates are different. So there isn't just one rate. There's an average of where rates are, but there's different rates for every single different situation. So mortgage rates are a lot like insurance. The riskier you are to loan to, the higher the interest rate. So if you're higher risk because of debt ratio, credit score, time on the job, whatever it is, there's adjustments to base rates based on those hits, is what we call them, or adjustments. So there isn't just one interest rate for everybody. So the advertisement you see on a billboard or an internet ad or something like that, generally, just like car loans, they're going to advertise their lowest rate they can possibly offer, when about 3% of the population can even get that interest rate, because the loan to value, credit score, down payment, time on the job, all the factors to make that a client is going to be the advertised rate. But by the time you actually apply, your rate is most likely going to be a little higher than that. But it's not, usually shouldn't jump up crazy, but there will be adjustments for your scenario versus that perfect mortgage client. All right, let's see what else we got here. What is a loan amortization and how does it work for borrowers at the bank? Loan amortization is essentially a schedule that shows you where your principal and interest is going. So it'll show your loan amount, your interest rate. It'll show how much is going to principal, how much is going to interest. If you look at an amortization schedule over a 30-year mortgage, the first 5 years is almost all going to interest. Then at that point, you start seeing a switch. Usually it takes into the 15th to 17th year, depending on the rate, depending on what you pay extra, before you start flipping it from more going to principal than to interest. But on a 30-year amortization, when you're amortizing over that time frame, the first 5 years is almost all interest. So if you can round up your payment a little bit, pay a little bit extra, you'll get ahead of that curve a little bit. But it is something where I always recommend my clients to make sure that you have your minimum payment set up on your mortgage. Any extra should go towards increasing retirement, increasing savings, paying off other debts that can go further than towards the mortgage. So it is something where I think it's good to round them up. But if you have other debts where $100 can go further than a mortgage, you should put that $100 towards those other debts first. So all you have left over is the mortgage, because it's appreciating. It's a fixed rate payment where other things may not have those features. You're far better off to get your savings set up, emergency funds, pay off other debts, and then start paying a little extra to the mortgage if you can. Let's see. Is buying another home easy for people who already own a house? It depends. It's not necessarily easier if that person is maxed out on their debt ratio, has lower credit scores, or doesn't have a down payment. Doesn't make it any easier. So I wouldn't say it's any easier to own the second or third or fourth home, because in some cases, actually, it's harder, because now you have to debt service additional loans. So just because you have a home loan doesn't mean you're automatically easier to get a home loan. Each loan stands on its own 2 feet. Each loan has its own guidelines, depending on the use of the property, depending on where your credit scores, your down payment, those types of things. So I'd actually probably lean towards no. Actually getting another house, if you still own the current home, can be trickier. Now, if you go to buy another house, so you've sold your house and you go to buy another home, it can be a little bit easier. But really, guidelines are guidelines, regardless if you're a first-time home buyer, second home buyer, move up, move down, whatever it is. Each loan has its own set of guidelines. So it's going to be easier or harder than the first loan, depending on how your guidelines have changed, how your situation has changed. All right, what else we got here? How are we doing on time? Oh, we're doing good. I hope you enjoyed these videos. Please like, share, comment, Let me know what I'm doing right, what I'm doing wrong. And if you have any questions, if there's anything specifically I can answer for you, you can also go to my website. You can see it down here below at ryanbolton.com. I have a little scheduler on there. If you want to schedule a call to either get pre-approved for a mortgage loan or just have questions, I'd love to be there for you. All right, let's see what else we got. A little bit of a sore throat today. Sorry, my voice has been a little sore the last couple of days. Let's see. What are the financial benefits to buying an old rather than new house? Financially, there can be benefits with buying a new home because it might be more energy efficient. So you may not have the cost of the equipment to run the furnace, the air conditioner, maybe the appliances are a little bit lower. So when you have an older home, you're typically going to run into situations where you're going to have to repair some of those things, or maybe the energy efficiency isn't quite there on an older home. The benefit is, though, typically any repairs that happen within the first few years have already been done on an older home. So you don't have some of those repairs needed to be done, or some of the mistakes or stuff that happens on a home. The first buyer kind of has to go through and fix some of those first things on a first home. But generally speaking, financial benefits, a newer home is going to cost a little bit less. Theoretically, it should, but a newer home sometimes costs more upfront. So it's kind of a trade-off between old and new. I mean, it's pretty general. I mean, and what is old? Are we talking a whole home built in the 1800s, or are we talking a home 10 years old, 20 years old, 30 years old? So it also depends on how old it is in relation to what else is out there. But I think there's benefits and disadvantages both ways. Older homes might be more mature. The landscaping might be more mature. The neighborhood might be more established. You're going to have other amenities that may be closer by, where newer subdivisions, maybe they're still a little further out of town, or maybe not as established, or you got trucks running all over the place because they're still building and digging up the lots and stuff like that. So there's different stages of every single home, but it really comes down to location. That's what real estate's always going to be about, whether it's new or old. Location matters more than anything else when it comes to real estate. All right, let's see. Ooh, how do you find the best mortgage provider? You use me. Self plug. So really, it's a matter of getting referrals, checking with people that have done mortgage business. You can check their reviews online. You can make sure they're licensed. I would say that's a big thing. All of us have an NMLS number, a National Mortgage Licensing System number. That number is tied to us no matter what state we go to. So it's not like somebody can commit mortgage fraud in New York and move to here, or vice versa. So we have these systems in place to make sure you're dealing with licensed individuals. There's also brokers and stuff that are above that have to monitor those licensees in every state. So there's definitely processes to make sure you're at least working with somebody that is licensed. But you can check their NMLS number, see if they have any complaints, see if they have any filings, any fraud issues. So that's definitely a first place to start. The next is just getting referrals, just like you would for any other dentist or doctor or anything like that. Check around, check their reviews, interview a couple different ones. You're going to interact with people differently, just like any other part of the business. So really, that's the best way to do it, is to just check references and how long they've been in the business, and who's done some business with them. All right, let's see. Time, we are doing about 13 minutes or so here, give or take. Let's jump into another section here. Let's go real estate financing. Let's see what this section brings up. And I try not to edit these. I just try to go live off the cuff. So bear with me as I find a good question for everybody, and one that seems to make sense. Oh, man. Okay. Let's see. Can a lender reject a home mortgage after giving clear to close? Can a lender reject a home mortgage after giving clear to close? Yes. So the clear to close is just the final step to issue the loan documents, means the approval is done. But let's say you get the clear to close, the loan documents are there, and you lose your job, or you have somebody that goes out and gets a car loan or a Visa loan, or something happens before the funding of the loan. So that's the crucial part. Clear to close is the culmination of all the underwriting guidelines, appraisals, title report, homeowner insurance, kind of all the culmination with the underwriter to sign off on it. The funding is the final stage where they do one final check. They usually will do one quick phone call to make sure they're still employed. They'll do one quick check on the credit to make sure no new debts showed up. Those are the two things that most commonly kill it after you're clear to close. There's usually something like that pretty major that happens. And so it is something where they can't, until it's funded, done, recorded, it's not done. That is what you really want. That's what you want to see. I mean, clear to close is 99%, 95% of the way there. So you're basically there, but that doesn't mean it's totally done until the keys are in your hand, it's recorded, done, funded, all those types of things. I mean, I've had times where people were going to send a wire and had an issue with their account. I mean, there's all kinds of stuff that can happen. Probably the most common is some sort of loss of job, or they go out and get a appliance package or furniture package with the store, or get a car or something like that. So we really try to educate our clients that hold on to your pennies, don't pull credit, don't do anything until you're the owner of the house, then do whatever you want after that point. But the short answer is, can a lender reject a home loan after giving clear to close? Yes, they can. Let's see. What are the benefits of having a home loan paid in full? You don't own a home loan anymore. You don't have that debt anymore. You don't have the chance to where missing a payment can make it so where you lose your property. So having a home free and clear is probably one of the second part of the American dream. Owning a home is incredible in America. You have such incredible financing options, limited down payments. I mean, there's so many things to encourage home ownership in America that is just amazing. It's really part of the American dream. The next step of that is having it then free and clear. But here's what I would also say to that. The only way you get to equity is selling or refinancing a home. So if you've got your house paid off, but you have any other debts, if you have no savings, no emergency fund, nothing that is liquid, and you can't get to that equity without selling or refinancing. So it's something where there's a balance between paying off a house and having emergency and having money in the bank. I like to really have a blend of both. I don't want to be just totally all equity. I don't want to be totally all debt. You know what I mean? It's not something where I want to have to debt service everything. But at the same time, my mortgage is one of the last things I would pay off, because the rates are better, the terms are better, the cash flow ability is better, the debt servicing is easier. And again, I can't get to that money, where if it's in a savings account, an emergency account, I can get to it. It just has more savings and a more emergency sense to it. But that can also be a catch-22. Too many people don't have a savings account because it's too easy to get to. So there's a balance between what you want to do. But having a house free and clear would be great if everything else is set up. Your emergency fund, savings, retirement, other debts. Once those are done, that's when I would start trying to tackle paying off the mortgage. All right, let's go with a couple more here. We will call it a night. How about that? Let's just go into general real estate. How long does it take for a real estate agent to look at a house? Well, however long it takes to drive over there. How long does it take for a real estate agent to look at a house? Yeah, it just comes down to their schedule, comes down to how far away it is to go look at it. So it just depends on if they're trying to get it as a listing or if they're trying to show it to a buyer. So yeah, that's kind of an interesting question. It usually doesn't take that long, just depending on their schedule. So what is the process of buying a home at an open house? So you can always submit an offer. It doesn't have to be just at an open house. Generally, an open house is an opportunity to go through the home. Maybe the homeowner is away, and the agent kind of stages the home to just have people kind of come through it. They usually send it out to their database. They usually send it out to other real estate agents saying, hey, we got this open house. If you have clients, bring them this day. It's a good way to be able to advertise the home. Plus, you'll have a lot of neighbors that'll come through. Maybe they'll have a family member that they'll want to have live close to them. So open houses are really a strategic way for agents to let the community know that this home is available and to kind of get into the home and take a look at it. But as far as submitting an offer, wouldn't be any different. Whether it's at the open house or the next day or the day after, you would submit the offer the same way through that listing agent that's doing the open house. Let's see. Can a borrower take out multiple loans to buy one home? Yes. So most of the lenders are going to have what's called a combined loan to value. The balance of the first will be the certain loan to value. Then anything above that would be combined loan to value. So many lenders still want to see money into the transaction. So they don't want to see 100% CLTV, combined loan to value. There is some programs that will allow for it. Like FHA allows you to do an FHA first mortgage and then what's called a community second to cover the down payment and closing costs. So the short answer is yes, you can do multiple loans to buy one home, depending on the guidelines of each of the loans. Many of the loans that allow for a first and second or combination loans have it built into their guidelines of what they will allow. But yes, the short answer is yes, you can get multiple loans. You can also get maybe a home equity line of credit on a different property and use that to buy an investment property. So even though that loan is not tied to that house, you've got one loan for down payment and then one loan for the actual purchase. So that's multiple loans, even if they're not on the same property. So yes, you can do multiple loans. Let's see. How much commission does a real estate agent make from selling their own home? Generally, there's not commissions on their own home, is what I've seen. It's either waived or the commissions are paid out to the buyer's agent. So when you have an agent that's listing the home, they usually will still offer a commission to any buyer's agent that shows up. But generally, they don't make a commission on selling the home because they're already selling the home. Now, I have seen times where they'll do a commission maybe to avoid capital gains or less money in the 1031 exchange, but that ends up going off to the broker, and there's usually some sort of fee or percentage that gets eaten up on that. So I would say generally, and maybe anybody in the comments can suggest in the area you're at, our area, I don't see a lot of real estate agents that are charging a commission basically to themselves to sell their own home. It is just already kind of built into the price. Can you skip payments when refinancing your home loan? So on a refinance, whenever you pay off the loan, so let's say here we are in the month of January, if you pay off the loan in January, you don't have a payment on the new loan in February, the first payment's due March 1. It's not really skipping a payment, even though there is some advertisers that will say, hey, skip a payment, miss a payment, that type of thing. When it's a little misleading, it's not really missing a payment, it's just how mortgage interest works. So when you make your payment for the month of January, you're actually covering the December's interest that's accrued. Same with February, covers January. So the interest is in the rears. So when you pay off that loan in January, the new loan replaces it, the interest accrues for the next month, you make your next payment. So it's really not skipping a payment per se, like you do. Like my credit union during the Christmas season would sometimes say, hey, skip your payment for December. They just add the interest to the loan. You're really actually skipping a payment. You're not having to make a payment, doesn't affect your credit, those types of things. When a mortgage doesn't really work that way, it's just simply how it's calculated and when the interest payment is actually due that allows you to potentially miss a month's worth of payments, not because it's not due, it's just not due yet. It's not due until the interest is actually accrued. So keep that in mind. It might be a little bit of a marketing strategy out there that, hey, skip and miss a payment, when really it's just not due yet. That's really what it is. All right, we are out of time for today's video. So hope you got some information out of this. I really enjoy doing these, a lot of fun. Sorry, my voice is a little raspy today, but I'll put out some more video, more content. If you have any suggestions on things you'd like to see or hear, please put in the comments. I'll make a video out of those in the future videos. And yeah, this has been a lot of fun. I hope you enjoy my channel, and let me know if there's anything else I can do for you. I do lending in Utah and Nevada. If you need help in other states, I can still help, and I can refer you to other people in most states. When you get kind of east of the Mississippi, that's when I don't have as many contacts. I work mostly in the West, but I'd love an opportunity to help you with a loan in Utah or Nevada, or any questions you have regardless of where the home or the property is. Have a wonderful day, and see you next time.